Let's dive into an introduction here. Taxable and non-taxable dispositions, incredibly important because when you sell something or you dispose of it, you get rid of it. You just, whatever it is, you gift it away, you get rid of it. Disposition, good general term for just getting rid of something, no matter what that means. Some of those dispositions will be taxable, some will be non-taxable, and a lot of IRS rules and regulations will follow. Now, these are important concepts to understanding how different transactions affect a taxpayer's liability. We've got taxable dispositions. These are going to generally refer to transactions that result in a gain or loss for tax purposes. Examples here, just the normal sale or exchange of property, whether it's real estate, personal property, stocks, or bonds. We got the gain or loss from taxable disposition is typically calculated as the difference between the amount realized and the adjusted basis. So we'll see very commonly, and I'll talk about this, realized recognized basis. Realized recognized basis. That's incredibly important. You'll get tired of me saying it. That's an incredibly important formula to have down. It'll get you through a lot of questions. Those are going to be specifically more so for like-kind transactions, which do come up in other lessons as well. Super important to know there. Taxable dispositions must be reported on the taxpayer's income tax return, and any gain must be subject to federal income tax. Depending on the nature of the asset and the holding period, gains from taxable dispositions may be classified as short-term or long-term capital gains, which can have different tax rates. And losses from taxable dispositions may be used to offset gains, and in some cases, ordinary income, subject to certain limitations. Nice general introduction. Obviously, we'll get much more in depth into the details and all of that fun stuff. Now we're dealing with non-taxable dispositions. These are going to refer to transactions that do not result in a gain or loss for tax purposes, or where the gain or loss is deferred to a later time. Examples here are going to include certain like-kind exchanges under Section 1031 of the IRC, involuntary conversions, and transfers of property between spouses during a divorce. In non-taxable dispositions, the tax basis of the relinquished property is generally transferred to the acquired property, and we defer any gain or loss until a later taxable disposition occurs. We see this a lot with partnerships as well. Generally, when you have a partnership and you get an asset distributed to you, you're not going to recognize a gain or loss. There's a lot of exceptions. We'll deal with hot assets and everything. And that's a deferred gain or loss because what happens is it affects the basis of the asset. You don't recognize gain or loss then, but a lower basis is less preferable because you want a higher basis. What you pay tax on is the difference between the eventual selling price and the basis. So you always want a higher basis. So if something's making you have a lower basis, then that's obviously not fun there. But that is how we account for these non-taxable dispositions. Eventually, it'll get taxed later on. The purpose of understanding these two types of dispositions is to determine the tax consequences of various transactions and make informed decisions about managing assets and liabilities. Properly reporting taxable dispositions and adhering to the requirements for non-taxable dispositions helps taxpayers maintain compliance with tax laws and minimize any potential tax liabilities. Sounds good. Pretty reasonable. Pretty straightforward. Let's keep moving along. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.